Hello, welcome to this episode of Rich Insights. I'm Don Rich, Head of Investments for Esoterica Capital Management. Today's topic is winners and losers. Now, earlier in the week, during one of the big down days, in fact, I suggested that I thought markets were about to calm down. Right? I thought the stimulus packages that were being proposed were meaningful for the first time. The actions that were being proposed by the government and the tremendous number of steps that have been taken by the U.S. Federal Reserve. And again, it wasn't only just the U.S., right? Central banks throughout the world, they've already enacted it, right? And I thought that was going to lead us to calm. I thought the market was going to pick up on it pretty quickly. Now, I have to tell you, that was a conditional expectation, right? A lot of what's been promised as a stimulus package, right? The most important components in my mind of what's been promised as a stimulus package by the government have not been passed yet. So if that doesn't come through, right, we're all going to be, as disappointed as my wife was on her wedding night. Right, we have to keep that in mind. But right now it does look like some calm is setting into the marketplace. But we should also realize what we've seen so far is really nothing more than short covering. Nothing more than short covering, right? Those that had been betting, investing to benefit from the downturn are having to cover their shorts, right? They're having to buy back their positions, cover their positions by buying them back. And that explains most of the stability or the slight rise in price we've seen so far. All right, so earlier in the week I was calling for this calmness, and I also cautioned that what's next? This isn't over. This isn't over by any means. Even though I was expecting calmness, that was signifying the depths of the first stage of this downturn, right? The first wave, as I call it, the first wave of this downturn. We were getting in front of the coronavirus for the first time. We took the first meaningful steps to break the link between the healthcare crisis and the financial crisis, right? But I think what we've experienced so far, from an investment perspective, from February 22nd to today, right? We went through a month of hell. No doubt about that. But I think what we've experienced so far is nothing more than a tremor. It's not the earthquake. Right? I said this before. I think the quake's still coming. Now, let's take a look at the chart. Try to make this point. You've seen this chart a number of times, right? The regular viewers. This is a number of distressed bonds traded in the U.S. All right. So these are bonds where distress is being defined as those that have a yield 10% higher than treasuries, right? 100 basis points higher than treasuries. Now, what have we seen recently? We've seen this thing go parabolic. All right, and you can see the most recent number of bonds right there. We've seen this thing go parabolic. That's obviously concerning. It's probably not all that surprising. But what might surprise you is even though we went through hell this last month, we are nowhere close to the depths that we've seen going forward. All right. So again, I've said this before. To me, the earthquake is the corporate bond market. I think that chart's going to make a new all-time high going forward. In 2008, we were the problem, right? It was the housing market. Individuals were driving up prices. Banks were culpable because they were extending mortgages too easily. And we had subprime mortgages and so forth. But for the most part, we were the problem. This time around, it's not us. Right? Individual balance sheets are in good shape. The bank's balance sheets are in good shape. That's not the problem. The problem is the U.S. corporations. They've developed a number of bad habits over the last few years. Leverage ratios have continued to increase. And now some of them are going to have to pay the piper. And we as taxpayers, we're going to have to determine which ones we want to keep and which ones we're willing to let go. Right? Who are going to be the winners and losers? Now, it's been said that every jackass thinks itself worthy of standing with the king's horses. Right? But that's not true. That's not true. We're going to have to let some of these jackasses go. All right, the two I want to highlight today, two things to give you to think about today. The first one is corporate inversions. This is a topic you've probably not heard about in the last 3 or 4 years. But corporate inversions are when a U.S. company relocates to a destination outside of the U.S. Right, that's called a corporate inversion. Why do they do that? Generally for tax or regulatory reasons. Other countries, particularly Ireland, had a much lower corporate tax rate than the U.S. So we saw over 50 U.S. companies leave the U.S. And now as those companies get in trouble, are we going to save them? They're not paying U.S. taxes. You want the U.S. taxpayer to bail them out even though they're not paying U.S. taxes? Say, shit, fat man, that one's an easy one. Let them go. They made their bed. Well, even though they're not paying U.S. taxes, these companies still employ a lot of U.S. individuals. All right, something to think about. Also, you should Google some of your favorite companies, and you'll be surprised at the ones that have inverted. It is some of the more popular ones that went through this corporate inversion process. All right, so something to think about going forward as we select the winners and losers. The other thing I want to highlight is stock buybacks. You know this has been a rock in my boot for a long time. Companies that have been issuing debt the last few years to buy back their own stock. That is value extraction. I told you at the time it's value extraction. It's not value creation. They were trying to pass it off at the time as value creation. That was bullshit. So their bad behavior now has caused them to be in trouble. Are we going to save them? Say, hell, that's an easy one again. Let them go. Well, the firms that were doing this, what? Who were some of the worst behaviors? The airlines, the oil companies, some of the industrials, the material companies, right? These are the household names. These are the bellwether names that we're talking about. They shouldn't have been doing it. They probably knew better, but they were being forced in the marketplace to do it. So we're going to have to decide whether or not we save those sorts of firms as well. These are not going to be easy decisions coming at us. But again, to summarize, I think we are very, very close to the end of the first downturn. The end of, to the depths of stage one, or the first wave. But I do think in the coming months, we're going to have more bad news coming. And when we see a massive amount of these corporate downgrades, that to me is going to be the earthquake. That's going to be the end of this nightmare that we're going through right now. All right. That's our message for today. I'm Don Rich. You've just experienced a rich insight. I hope you've enjoyed that. May your beer be colder than the company you keep. Talk again soon. Thank you.